Welcome to PwC IFRS Talks, your source of all things IFRS, technical accounting matters, business issues, current standard setting, and regulatory updates. I'm your host, Ruth Preedy. In today's episode, we've got Q1 update. However, we're going to have a financial instrument focus. So I'm just joined by I'm very lucky to be joined by the lovely Sandra Thompson. Welcome back, Sandra.
Thank you, Ruth.
And you hear I'm a bit croaky. I'll try and keep my distance, Sandra, and not give you my cold.
Appreciated.
Yeah, what's happening in Q1? I've got sick. But yeah, so there's lots of stuff going on in Q1, and I'll give you some other resources, or the listeners some other resources to listen to as well. But we're going to focus a little bit on what's been going on in the financial instruments world. Obviously, IFRS 15 revenue and IFRS 9 financial instruments was actually effective last year, but coming into Q1, it'd be good to reflect. Is there anything you want to sort of share with the listeners about IFRS 9?
Yeah, sure. Thank you, Ruth. So I think the first thing to say is most of the issues were those we expected. So for the corporates, two biggest issues were probably debt modifications and the change there we've talked about before, and also the requirement to fair value all equity instruments, all equity investments, and of course impairment. And I think for banks it was mainly focused around impairment and getting the models up and running and then explaining the numbers. I've got one particular issue I'd like to flag, and then I might reflect on some good things we saw at year-end.
I like good things.
So the issue I want to flag is an impairment question. Many banks and corporates, and indeed all kinds of entities, have holdings of sovereign debt, government bonds.
Yeah.
Commonly they're measured at amortised cost or fair value OCI, so they do fall within the scope of IFRS 9's impairment requirements. And some questions arose about, well, how do you do an impairment on a government debt? Now, clearly governments are of many different types. Yeah. There are some extremely creditworthy governments around the world, and there are some perhaps less creditworthy governments around the world, so everything else, it depends. However, the particular issue that came out if you're holding a government debt, perhaps from a less creditworthy government, is, well, if a government gets into financial difficulty, they can always just print money, can't they? They can always repay their debt because they'll just print more money, such that they have enough money available in the system to repay debt. And therefore, we don't need to book any ECL, do we? There isn't any impairment on government debt. It has to be zero. You won't be surprised to learn the answer to that is no.
Yeah.
That these are in the scope of IFRS 9's impairment requirements. You have to apply the impairment model in the same way as for any other financial asset in the scope of the impairment requirements. And I think there's plenty of cases you can point to in history where governments couldn't print money indefinitely and they did default. So you do have to look at the probability of a default and then the loss that would result if that default happened. Now, for some kinds of governments, that may well give you a number that's immaterial, but for others it won't. And you just go through the normal model. You can't say because a government can print money forevermore, there can't be any impairment.
So we're not expecting any policies that say sovereign debt, we just ignore.
Indeed,
Need to go through the full model. Yeah. And what were your good things?
The good things. So I thought it'd be good to particularly focus on disclosures, because some people really put some effort into thinking, how can I explain the impacts of IFRS 9? I'm going to split this into two bits. I'm going to talk about the corporates who have different considerations to the bank. So if we talk first with the corporates, now for many corporates the impact was not material, so everything I say will be couched with that in mind. However, some corporates actually said it's not material and this is why, and indeed some regulators encouraged corporates to do that, and I think that can be a helpful disclosure, particularly if there are quite large amounts of financial assets on the balance sheet. Well, why isn't it material? In terms of the actual disclosure of the impact, so starting with impairment, we saw some corporates talk about the use of a provisions matrix, quite a common tool for a corporate to use, how they'd done their provisions matrix, how it was different from what they did under IAS 39, and explaining the impact on transition. And then contract assets. So IFRS 15 contract assets were not under IAS 39's impairment, are in IFRS 9. So again, explaining that fact and how the model had been run for a contract asset and the pickup in the numbers. So two good things there. The other big area for corporates is hedge accounting. And there are quite a number of new disclosures for hedge accounting, and these apply even if you haven't adopted IFRS 9's hedge accounting requirements. You're still on 39 hedge accounting, the disclosures still apply. Those disclosures include some requirements for a table that sets out things like the nominal value of derivatives used in hedges, the carrying values and the fair value, the gains and losses that have been booked and where they've gone, which line items in the income statement are affected. And we saw some disclosures, some corporates really make a good job of that.
Great.
And really group their hedges quite sensibly. and use it to really explain much more their hedge accounting. So the analyst, the user of the financial statements, can really see the impact the hedge accounting's had. The other disclosure that IFRS 7 requires is to look at the timing of the hedge. So what periods will this hedging instrument unwind over, and what's the average hedged price or rate? I have to say, I think corporates have struggled a bit more with that one. There's obviously a balance to be struck between doing something meaningful, so not giving pages and pages because you've got hundreds of hedges, but also not over aggregating so you lose the benefit of the disclosure. We've seen a couple of good instances, but probably some more evolution, I suspect, to go on there. So that's the corporates. I'm sure you can say, what about the banks?
Tell me about the banks.
And I'm going to focus solely on impairments. And I've talked about disclosure by banks before, but the one thing I'll pick up on is, what about sensitivity analysis? What about the requirement to model different scenarios and giving some insight into that? And again, I think we saw some banks who'd really put some thought and effort into this and did a very good job. So in terms of how might you give a reader the flavour for what sensitivities, how the number might change, and what's the impact of doing multiple scenarios, we saw a number of banks who say, well, I modelled 3 scenarios, 5 scenarios, but they said what the impairment number would have been had one of those scenarios been the only scenario. So maybe you model an upside, a downside, and a base case, say what the impairment would have been had the downside been the only scenario you've looked at. And clearly that gives a flavour for how things might change in more constrained economic conditions. We also saw some banks giving sensitivities to the change in some of the inputs. So maybe if unemployment changed by X, the impairment number would shift by Y, or GDP or house price indices. Now clearly there's limitations if you only do that for one variable, because it's very unusual for one of those to change on its own, and some people did it for more than one. But again, it gives a flavour as to how the impairment number might move. We saw some quite good disclosures around staging. So what would be the impact if a certain percentage of my stage 1 booked moved into stage 2? How would that kick up the impairment number? Or indeed, if there was just a 25% increase across the board in all of the PDs, how would that flow through into impairment? And then the final one I might pick out is how much of the ECL came from each of the multiple scenarios. So you had a total ECL of 100, so much came from the base case, so much came from the downside, and so much from the upside. Again, giving a flavour of how much impact layering on the multiple scenarios has had. The other one is overlay. So you run your impairment model. There's some things that aren't captured well by the model, so you do an additional adjustment, an overlay. Certainly in the UK, we've seen some loads of Brexit, uncommon. It's a difficult thing to model, and some good disclosures about how that overlay had been constructed, how many scenarios have gone into it, and really explaining the number. So some very good ones there, and I hope those will continue as Brexit becomes hopefully a bit more certain as we move forwards. So that's the kind of the what. In terms of the how, very good use of graphs. Again, the picture is worth 1,000 words, and I think particularly when we come to next year end and explaining how things have moved, graphs can be a very powerful way of doing that. So some very good examples to look to.
I love it that we've got such positive news for our listeners. So well done if you listened in and you thought, my IFRS 9 disclosures tick all the boxes that Sandra said. If you're listening and thinking they could be improved, maybe that's something you can look at going forward. So we've come into Q1 now. We talked about 15 and 9 were effective last year. Is there any new standards people should be aware of this year, if they don't already know?
Oh, well, of course, the big one is IFRS 16, the new leasing standard. Applies from the 1st of January 2019, so when you get to Q1 you will be adopting IFRS 16. I'm not going to say a lot on this. We are about to put out an in-brief that will talk about interim disclosures and what helpful disclosures you might give around transition. And the other one is not actually a new standard, it's an IFRIC interpretation, which is IFRIC 23 on uncertain tax positions. So if you haven't picked that one up, make sure you do.
Brilliant. Okay, so 2 big things there to be aware of. And like Sandra said, lots of stuff on both of those actually on Inform, but IFRS 16 specifically, loads of guidance coming out. We've also, one thing people should be aware of is always what's going on at the IFRIC. March IFRIC was a very packed agenda. We do actually have a separate podcast. That's why we're focusing just on FI today, although there were lots of FI stuff on the IFRIC agenda as well. So Tony DeBell did another podcast a couple of weeks ago. That should be on pwc.com/IFRS Talks now. So don't forget to look at that as well. The second part of our podcast, what we're going to focus on is something that's coming rather than something that's already in there. And this is all around the replacement of LIBOR. So before we get into the sort of what's the financial reporting, could you just explain to listeners what does that actually mean? Explain to me, Sandra.
Yeah, it's nice bit of jargon. What do you mean? So after the financial crisis, there was concern about how some of the IBOR rates have been constructed, and maybe that in some cases the rates have been rigged. And as part of that, there's a number of regulators around most parts of the world looking at moving off LIBOR, very commonly quoted reference rate, into other kinds of reference rates, sometimes called risk-free rates or RFRs. So, and that's going on a number of countries around the world, and different countries are moving at different speeds, and they're moving to different rates. But it's a very wholesale, it's kind of a once-in-a-lifetime wholesale reform. Now, given IBOR is actually pretty prevalent in financial reporting, I think this will impact pretty much everybody. Lots of companies have floating rate debt that is 3-month LIBOR plus a spread. And then even if you haven't got floating rate debt, lots of valuations that we do under IFRS have an IBOR component in there somewhere, typically in the discount rate that's used to calculate, say, a non-financial impairment number or a fair value. So this is going to be a pretty prevalent effect on companies. Yeah. So
that sounds, like you said, it could be huge. What are some of the big financial reporting impacts that people should be aware of?
Well, I think this probably brings me on neatly to what the ISB is doing. So I think there's kind of two groups of impacts. So we sit here today, and IBOR reform hasn't yet happened, but everybody knows it's coming.
Yeah.
And there's the what do I need to worry about today before it happens? And the ISB in its project has done that as phase 1, and that's really about hedge accounting. And then we will get to some point in the future where IBOR reform will actually happen. So the old IBOR rates will be replaced with the new rates, whatever they are. And then there's a bunch of accounting questions around, well, what do I do now? How do I update all the accounting impacts of that? So that's broadly what we should be looking out for. Do you want me to,
tell me about hedging. So that sounds like the thing we need to think about now.
I'll focus on the first of those because, as I said, the ISB has a project to look at IBOR reform and look at what reliefs we might give from the normal accounting rules to help people over the transition. And they split that into the same 2 phases. And at the moment, they're working on phase 1. So what do we need to worry about before IBOR reform actually happens? And as I said, that really is hedge accounting. Now, the ISB's had a couple of discussions. We expect to see an exposure draft quite shortly. I'll come back to timing. And I'm going to talk through what we think that exposure draft is going to say. So the first question with hedge accounting is the highly probable requirement. So if you're hedging a forecast future transaction, future cash flows, they need to be highly probable. The most common instance of this is a company that's issued floating rate debt, take 3-month LIBOR plus a spread, and has hedged the IBOR cash flows and designated its hedge in terms of IBOR. So they swap that debt from floating to fixed with an interest rate swap, and so they're hedging the IBOR cash flows. Now let's suppose it's a 20-year debt. If you look forward 20 years, is it highly probable
that there will be
IBOR cash flows for the next 20 years? Well, there's going to come a point at which, quite frankly, it's not. Because we all know that IBOR reform is coming. And does that mean you can carry on with hedge accounting? And the ISB is aware of this. It's likely to propose some relief that says, for the purpose of the highly probable test, you assume today's cash flows remain unchanged. So if you've got LIBOR today, you can assume LIBOR for the full 20 years, which is very helpful relief. That's the first one. The second one is around the need for an economic relationship if you're an IFRS 9. So that's an economic relationship between your debt and the derivative you're using to hedge. Or if you're in IAS 39, then it's the need to demonstrate the hedge will be highly effective. And the difficulty here is that we don't quite know when IBOR's coming, how it will play out. Will derivatives move before cash instruments? What will the new rates be? Will everything move to a 3-month rate? Will it be overnight rates? May there be a mix of the two? So there's lots of uncertainty, which makes it quite hard to do that test. So the relief we're expecting that the ISB will propose is to say that you can use the current contractual terms. So again, if you have an IBOR debt today and an IBOR derivative, you just assume those 2 current IBOR rates remain unchanged. Again, very welcome relief. The third one is around risk components, and I'm going to flip over now into a fair value hedge because this is probably where this has the biggest impact. So many companies don't issue floating rate debt, they issue fixed rate debt, and they swap those into floating, so they'll have an interest rate swap that goes the other way. And it's quite common to designate that hedge as the change in fair value attributable to changes in IBOR. And that's, if you like, a separate risk component. You're hedging the IBOR risk component in that debt. Now, that's separately identifiable today probably, and you're quite happy to do hedge accounting. When you look forwards, will it remain separately identifiable? Will I be able to see an IBOR component of fixed rate debt in 5, 10, 15 years' time? Well, again, there's lots of uncertainty around that. So the relief we're expecting is the ISB will say, well, if your risk component was separately identifiable on day one, then you don't need to reassess that. You can carry on assuming it is separately identifiable. So therefore my fair value hedge could continue. So you can see 3 very useful reliefs. Given the speed of IBOR reform in some territories, we probably need these sooner rather than later.
Yeah, I was going to say. So tell me, so you mentioned there that they're going to come up with an exposure draft soon. What's the plan on timing?
We think it's going to be probably beginning of May, end of April, beginning of May, short comment period because they are aware of the need to get this in place. So probably 45-day comment period. Okay. And then with the aim to finalise it by year end with retrospective application, but also early adoption permitted. So although they were mandatory from the 1st of January 2020, you can adopt it early if you need it for 2019. Okay, then you'll be able to adopt it. That's what's envisaged.
Okay, that's good. So fast-moving standard setting there. So that's the phase 1 of the project, like you said, is focused around hedging, and then phase 2 then comes into basically when it comes out. So that's a bit of watch and see.
So it is a bit of watch and see. So we expect that to cover hedge accounting when you actually moved.
Yeah.
Hedge documentation is going to change.
All
that
updated,
start hedge accounting. And also when you actually change the terms of a debt instrument, what's the accounting for that? The ISB hasn't really started looking at phase 2. It's very aware of the issues. I think it would like a bit more certainty as to how this will actually play out, but it is aware that it needs to think about these issues.
They've got a 45-day comment period to focus on. It's fast moving.
Yeah.
Okay, perfect. So great news that the ISB is doing something, and great for you to share with listeners what they should be thinking about. If they are listening and thinking this is definitely going to impact me, what should they be doing now?
A couple of things I'd say. So firstly, make sure you know your impact. So what contracts have you got? Make sure you've identified all the contracts that are going to be affected. The obvious places to look are derivatives and debt instruments, but also some leases have IBOR reference rate clauses in them. So make sure you look broadly and identify all the contracts you might need to. The other thing is clearly look for the exposure draft. Read it, see if you think it will help you. If you don't think there's enough relief for what you need, then tell the ISB. They're very much in listening mode. It is a short comment period, so watch for it when it comes out and be ready to comment and feedback. And
where can people go for help? Have we got some stuff out?
Yeah, we do.
Must have.
So PwC has an IBOR reform webpage.
Yeah. You
can find it easily on the pwc.com website. And that covers all aspects of IBOR reform, but including this. So there is we did an in-depth, I think.
Yeah.
An in-depth towards it just at the back end of last year that you can easily get off ifrs.com/ifrs.
Brilliant.
pwc.com/ifrs.
That's fine. Because I think we've obviously focused on IFRS podcast, so we focus on the financial reporting, but obviously this is going to have a big old impact. And hopefully maybe you'll come back, Sandra, and tell us about a broader everything that people need to think about.
I think we might do a special IBOR reform podcast.
That's very exciting. We'll pick up some of the
broader impacts as well as some things we've not had time to cover today.
Brilliant. Okay, well, Ed, thank you very much for joining us, Sandra. FI themed Q1 podcast. For all that extra information, like we said, we've lots of things there. So we've got the IBOR reform page on pwc.com. We've got the March IFRIC podcast if you want to keep up to date with IFRIC, which is on the IFRS Talks page. And we've also got lots of guidance coming out around IFRS 16 as well on Inform. So thanks very much for listening. I've been your host, Ruth Preedy. Happy accounting. The preceding programme was brought to you by PricewaterhouseCoopers LLP. This content is for general information purposes and is not a substitute for consultation with professional advisors.